Shanghai didn't just move the silver market, it shocked the entire global system. Within hours, prices didn't just rise, they exploded. And just when momentum looked unstoppable, China stepped in, not to push it higher, but to slow it down. Why would the world's biggest commodity player hit the brakes on a booming market? That's the question no one can ignore right now, and the answer could change how you see money forever. If you want real insights before the rest of the world catches on, subscribe to Metal Market Insight, because moves like this don't come with warnings. Now, here's where things get serious. This wasn't a random spike. This was pressure building quietly for months. Industrial demand was rising, supply was tightening, and investors were slowly shifting away from traditional assets into hard commodities. And silver, usually overshadowed by gold, suddenly started acting very differently. But this wasn't retail hype. This wasn't small traders chasing momentum. This was deeper. Larger orders, aggressive positioning, and smart money moving early. Because in China, markets don't just explode without a reason, and they definitely don't get interrupted without one. And then it happened. Trading restrictions, margin adjustments, volatility controls tightening, and just like that, the signal was clear. The system was under stress. And when a system shows stress, two things rise at the same time: opportunity and risk. Because silver isn't just another metal. It sits at a rare intersection of industrial demand and monetary value. It powers electronics, solar panels, and future technologies. But at the same time, it acts like money when confidence starts to crack. And when those two forces collide, real demand and financial fear, markets don't move normally. They move violently. That's exactly what we're seeing right now. But here's what most people are missing. China didn't step in to stop the rally. They stepped in to control the speed. Because when prices rise too fast, panic follows. And panic doesn't stay contained. It spreads across markets, across assets, and across borders. And right now, the global system is already fragile, with inflation still lingering, interest rates uncertain, and geopolitical tensions everywhere. If silver starts running too fast, it sends a dangerous signal that investors are losing trust in currencies and moving toward real assets. That's not something central authorities want happening too quickly. So China slows it down, not to kill the move, but to manage it. And that distinction matters, because slowing momentum doesn't end a trend. It often extends it, making it stronger, more sustainable, and sometimes even bigger. So the real question isn't whether this is over, it's whether this is just the beginning. Drop your opinion in the comments. Is this just a temporary spike, or the start of something much bigger? Because moments like this don't come often, and when they do, they tend to separate those who are paying attention from those who aren't. Now let's break this down further. When markets get restricted like this, it usually comes down to three things: excessive speculation, liquidity pressure, or systemic risk. And in this situation, it could easily be a combination of all three happening at once. Speculation drives prices up quickly. Liquidity issues make those moves unstable. But systemic risk is what authorities fear the most, because that's when one disruption starts affecting everything else. One crack in the system can quickly turn into a chain reaction. And remember, this is happening in China, one of the most important players in global manufacturing and commodities. If instability starts here, it doesn't stay local. It spreads through supply chains, pricing systems, and eventually into global markets. And yes, even into the United States. Because silver doesn't trade in isolation. What happens in Shanghai eventually echoes in New York through futures markets, investor sentiment, and capital flow. And historically, when one major market experiences a shock like this, others tend to follow. Sometimes immediately, sometimes with a delay, but the impact always spreads. That delay is exactly where smart investors start paying attention. Because by the time headlines catch up, the biggest moves are often already underway. That's why moments like this matter so much. They reveal cracks before they become visible. They show shifts in confidence, changes in risk appetite, and early signs of where capital is moving next. And right now, silver is sitting right in the middle of that shift. The biggest question isn't just about volatility anymore, it's about repricing. Because if confidence in traditional financial systems continues to weaken, silver doesn't just rise temporarily, it can get completely revalued on a global scale. But it's important to stay grounded. Markets don't move in straight lines. Pullbacks happen, corrections are normal, and volatility always cuts both ways. So while the upside looks exciting, the risk is still very real. And that's why informed investors don't chase moves emotionally. They watch, they understand, and they act with patience instead of panic. Because in moments like this, clarity matters more than speed. So what happens next? There are three possible paths unfolding right now. The first is stabilization, where China's intervention successfully cools the market and prices settle into a more controlled range as supply and demand rebalance. The second is continued pressure, where despite restrictions, underlying demand remains strong and silver keeps grinding higher, not in explosive moves, but in a slow, sustained uptrend that builds over time. The third scenario is escalation, where external shocks like geopolitical tensions or economic surprises add fuel to the fire, forcing another wave of volatility and potentially stronger interventions from regulators. Each of these paths carries very different implications, not just for traders, but for industries, investors, and even everyday consumers, because silver is deeply connected to technology, manufacturing, and the global energy transition. And here's something most people overlook. Events like this fade from headlines quickly, but their effects don't disappear. They continue shaping markets quietly in the background, influencing pricing, sentiment, and long-term positioning. And to understand why this matters, you have to zoom out beyond just silver prices. What we are really seeing is a battle between physical demand and financial control. On one side, real-world usage is increasing every year. On the other side, global financial systems are trying to manage speed, stability, and sentiment. Because when a market like silver starts moving aggressively, it doesn't stay isolated as a trading chart. It starts influencing expectations. Manufacturers begin adjusting costs, investors start repositioning portfolios, and even central institutions begin reassessing risk exposure across multiple sectors. Another key factor here is timing. These kinds of moves don't happen in a vacuum. They usually build quietly in the background, away from mainstream attention, until suddenly the pressure becomes visible in price action. And by the time it becomes obvious, most of the early positioning has already taken place. That's why sharp moves like this often create confusion in the market. Some see it as speculation, others see it as a structural shift, but the truth is usually somewhere in between, where short-term volatility overlaps with longer-term change. And in situations like this, the reaction from authorities becomes just as important as the move itself. Because how regulators respond often tells you how serious the underlying stress really is, even if they never say it directly. And if you look closely, this isn't the first time we've seen something like this. Markets throughout history have gone through phases where a single asset suddenly becomes the center of attention, not just because of price, but because of what it represents at that moment in time. Right now, silver is starting to carry that kind of weight. It's no longer just reacting to the market. It's beginning to send signals of its own, signals about demand strength, about investor behavior, and more importantly, about confidence in the broader financial system. Because when confidence is strong, money flows into growth assets. But when uncertainty starts creeping in, capital begins to shift toward things that feel more tangible, more secure, and more independent of policy decisions. And that's exactly where silver starts to stand out. Another layer to this is how quickly sentiment can change. Markets today are more connected than ever, and information spreads instantly. A move that begins in one region can influence decisions globally within hours, amplifying both opportunity and risk at the same time. And this speed is what makes situations like this so important to watch carefully. Because when momentum builds in a connected system, it doesn't just grow, it accelerates. And once that acceleration reaches a certain point, controlling it becomes much more difficult, even for the biggest players in the market. By the time attention returns, the market can already look completely different. That's why staying informed consistently matters more than reacting emotionally to headlines, because real opportunity is usually built in the quiet phases, not the loud ones. And that's exactly what we focus on here at Metal Market Insight, breaking down complex market moves into clear, understandable insights so you can see the bigger picture before it becomes obvious to everyone else. Because this isn't just about a price spike in Shanghai, it's about what that spike represents. A potential shift in how the silver market behaves in a rapidly changing global economy, one where old patterns may not hold the same way anymore. So stay alert, stay informed, and stay curious. Because the next major move in this story may not come with a warning, and when it happens, those who understand the context will be in a far stronger position to respond. This content is for informational and educational purposes only and should not be considered financial advice. Always do your own research and consult a qualified financial professional before making investment decisions. Markets involve risk, and past performance does not guarantee future results. Subscribe to Metal Market Insight for more market breakdowns like this.